The problem from this video can be downloaded at accountingworkbook.com. If you go to the website, click the PDF link and you can download a copy of this and all of my problems for yourself. Now, if you check the website and you click on videos, you'll see there are more videos than those I've listed publicly on YouTube. You can see that there's every problem covered in the workbook has either a public video or a members only video. If you'd like access to the members only video, just click the join button beneath the video player on YouTube. All right, let's jump into the problem. Let's examine problem 6.3a. This has us combining purchases and sales. If you did 6.1 and you did 6.2, they kind of separated them and gave you just a small taste. 6.3a kind of puts it all together and even adds a little bit more. So let's get going. The following transactions occurred for Romney Inc. and big long list of transactions, and it says give us journal entries. Okay, so that's what we're going to do. Let's start with the first one, Feb 1st. Purchased inventory on account, $3,400. Okay, so we're buying inventory on account. When you buy inventory on account, debit inventory. And the amount was $3,400. We credit AP $3,400. Now remember the terms, 2% discount if we pay within 10 days. Otherwise, we've got to pay the full amount within 30. February 2nd, paid freight on the inventory. Okay, we haven't had to deal with this yet. So paid cash of $200. So let's credit cash because that's the easy part here. $200. Now, very interesting here. When you pay to have inventory delivered, the cost of acquiring the asset, the cost to make any asset kind of useful to you is actually considered not an expense, but part of the cost of the asset. So part of the cost of the inventory is the delivery charge, which is a little bit weird. Again, I think a logical person might look at this and say, oh, debit freight expense or delivery expense or something like this. We do not debit that. We say, look, the cost of the inventory, if you wanted to get this inventory, $3,400, it was necessary to pay the $200 on top to acquire the inventory. That's part of your inventory cost. So we actually debit inventory here for $200. So again, $3,400 of inventory plus $200 of shipping, it's actually a $3,600 piece of inventory or bunch of inventory. Okay, so that was February 2nd. February 5th. Bad news here, we returned $400 of inventory. Okay, so we were returning some inventory. Credit inventory. $400. Debit AP, we're saying we don't owe you that $400 anymore. We are returning the inventory. We're assuming everybody agrees to that. February 9th, we pay for the inventory. When I pay for the inventory, I got to credit cash, but we got to figure out how much. Now, as we're looking at this, I'm ignoring this part of the transaction, right? This freight part, because I've already paid the freight. I don't have to worry about that. But I do have to worry about this $3,400 inventory purchase and the $400 return. Well, guess what? Now it's $3,000 worth of inventory. Now the question is, do I qualify for the discount? The answer is, well, I paid within 10 days. Yes. So I get a 2% discount, which is a $60 discount, meaning I pay $29.40, right? $29.40 I pay, $60 is discount. Well, if I pay $29.40, credit cash $29.40 on February 9th. I debit AP to say, whatever I owed on this, I don't owe anymore. I've paid the bill in full, and the bill in full was $3,000, right? It was the $3,400 minus the $400. I still owed $3,000 on the bill, so I got to debit AP for that $3,000, and you can see now I've got $3,400 in debits to AP, $3,400 in credits to AP. But wait, you say, there's a $60 missing amount. This reduces our inventory value. We only paid $29.40 for the inventory, so that $60 discount comes out of the value of the inventory. Okay, moving on. February 11th now. Sold inventory for $3,500 on account. The inventory cost $1,600, terms 210, net 30. So we sold $3,500 of inventory, or inventory that was priced at $3,500. So let's deal with that. February 11th, debit cash. No, not cash. We sold on account. Debit accounts receivable. Credit sales rev for how much? 30. I thought it was 30. Yeah, there it is. 3,500. Sorry, I was going blind there. Debit AR, credit sales, debit cost of goods sold, credit inventory for what we sold. So for the cost, and that was $1,600. Now again, there are discount terms on this, so when I make this sale, I'm keeping that in mind, that I'm gonna probably or possibly need to adjust this. February 14th, Valentine's Day. Well, now we're starting to juggle. We purchased some inventory, $2,500, terms 115, net 30. All right, so Feb 14th. Debit inventory, credit AP for an inventory purchase, and the amount was $2,500. We make another sale on February 19th. Oh my goodness. Sold inventory $1,500 on account. $600 was the cost. Terms 210, net 30. Okay, whenever I sell inventory, again, I'm thinking two entries. Debit AR, credit sales, rev, debit cost of goods sold, credit inventory, and the amounts were given up there. The amounts were on February 19th. $1,500 was the sales amount, $600 was the COGS amount. Okay, that's it for February 19th. February the 21st, paid for the inventory purchase from February 14th. Okay, so on February 14th, we purchased inventory, terms 115, net 30. Yes, when we pay, we are taking our discount. There were no sales returns in between, so it's a $2,500 bill, but we take a 1% discount. You can see the terms are 115, net 30. So this is a $25 discount, meaning we pay $24.75. So let's do it. February, I think it was 21st. Let me just check on my key so I don't scroll back up. Yeah, February 21st. We're going to credit cash $24.75. We're going to debit AP, and the AP related to our February 14th amount was $2,500. So debit AP $2,500, and then there's this $25 discount amount. That is a reduction in our inventory value. We did not pay the full $24.70. We did not pay the full $2,500 for inventory. We paid $24.75. So we got to reduce our inventory value by that $25 discount. It's the inventory value. The inventory on the books is what you paid for it, not some full price amount. It's the discounted amount. Next, February 24th. Customer from February 11th transaction paid the amount owing. Okay, so let's see what happened on February 11th. Let's remember the details of that. Sold $3,000 of inventory on account. Terms 210, net 30. Feb 24th, they pay. They don't get their discount. So they just got to pay the full amount. Okay, so they got to pay us. They owed us $3,500. Guess what? They got to pay us $3,500. So February 24th, debit cash, $3,500, credit AR, $3,500. That was a simpler one. Next, February 25th. Customer from February 19th transaction. Let's highlight that transaction. returns $100 worth of inventory, cost $40. The inventory was good condition and put back on the shelf for resale. Okay, so they made a $100 return, and we're going to give them $100 credit to their account. So again, they made this purchase, a $1,500 purchase, and they said, hey, $100 this we didn't like. We'll give them $100 credit to their AR. This was on February the 25th. Credit AR by $100. The debit is to sales returns, $100. So they've returned the item. It goes to this contra revenue account called sales returns. So far, so good. We got to put the inventory back on the shelf, and it's $40 worth of our inventory. The credit is to COGS to say, okay, that stuff that we said was goods that we sold, we didn't sell it, right? We went debit, COGS, credit, inventory. Now we're saying reverse that. That sale didn't happen. Flip that portion of the sale back. So there, we've done it. Last, but certainly not least, and one of the trickier ones, and this is just a juggling act, right? All we're doing is juggling here. Customer from February 19th sale pays the amount owing. Okay, so we got to figure out what they owe us. So I'm going to erase this stuff just because we're not really referring to it anymore. Okay. So February 19th sale was a $1,500 sale, and they've returned $100 worth of merchandise. So it's really $1,400 that we are planning to collect. But guess what? They paid within 10 days. Terms were a 2% discount. February 19th to 28th, it is within 10 days. So they can take a 2% discount. They get $28 off, meaning they pay $1,400 minus $28 is $1,372. Okay, let's deal with that. This is on Feb 28th. Debit cash. I forgot the amount already. $1,372. We got to get rid of their AR. Their AR was $1,400. It was $1,500, but it went down to $1,400. So we get rid of their AR, and we're left with $28 in debits. This amount, again, it's like a reduction of our sales revenue, but there's a specific account for this called sales discounts. We gave a discount, and this gets as a contra revenue account. It reduces our sales revenue by $28. Okay. I think we have done it here, ladies and gentlemen. We've made it to the bottom of this problem. All sorts of purchases, returns, discounts, etc. A challenging problem, but it's more of a juggling act. I don't think it's, if you look at each individual transaction, I don't think it's any harder than 6-1 or 6-2, but it's just that there's so many of them. That's all for this video. Stay tuned for our next one. Bye for now.